So, Scarlet, I think the issue is a little bit more complex when it comes to credit. Because from the equity perspective, it's all about valuation, all about growth. From the credit perspective, what we're sort of dissecting is, okay, yes, all these companies sunk so much money into iGaming and sports betting. And it's more how much of the prediction or how much of the iGaming sports betting is of their revenue and of their Ebitda now and what it's expected to be going forward. So that's where something like MGM's diversification globally really comes into play. The fact that they're only 50% in the US market because they have a joint venture with Entain, and the fact that they have such a global reach in comparison to Penn and Caesars really makes a big difference in terms of this discussion.
So where are we? The 30,000-foot view of these prediction markets. What's the regulatory overview here? What's the story here?
Well, it's changing every day, and Elliot Stein and Brian Egger and Nathan Dean have really been on top of it. It's fantastic work. But I think that the key is that it's really heating up between a states versus federal rights at the moment. And you're having a bunch of states getting really angry because the CFTC is basically saying, yeah, we can do this in your state. We can force it in. And the states are saying, no, we don't want gambling in our state. You can't force this. This is gambling of another name. And that's where it gets a little bit finicky, is the question of, is it gambling? And what's so interesting is we leveraged AltD, so the alternative data platform. We have something called Similar Web, which is basically web traffic. And so when you go into a website, not an app, but a website of a company. So if you type in, DraftKings.com, it registers on there. And if you look at that in comparison and you see these points of important events such as the U.S. election, the presidential election, or the Super Bowl this past February, you are seeing these giant spikes in the prediction market names like Polymarket and Kalshi. You're seeing these big spikes in comparison to the traditional iGaming and sports betting names. I say traditional air quotes because it's still a relatively new industry in general. Mm-hmm. I mean, there's only so many states that allow it in the first place, and it's still getting mature every day. And so now you have this wrinkle where these companies said, this is a whole new area for us to do vertical integration. And the prediction markets are saying, just kidding, we're going to throw a whole monkey wrench in your structure.
Is the UK any kind of guide or example that you can look to for an understanding of how things unfold? Because prediction markets are legal in the UK. They're fully regulated. And sports betting has been legal in the UK for much longer than the US.
I think, Scarlet, where you can sort of draw a comparison is how large it could penetrate the market potentially.
The growth potential.
Right, the growth potential. Now, that said, I mean, when you look at casinos in the US versus casinos in the UK, it's a different comparison. You also look at the wealth of the US versus wealth of UK and wealth distribution, right? So it's a very different conversation from that perspective. But in terms of getting some sort of sense of how large a market it is, it really isn't that big of a market or market potential. That said, for these companies like Caesars, like Penn, they dumped in over $3 billion over the past 10 years in growing their online gaming and sports betting. They had a joint venture or a relationship with Disney that failed. Now they're rebranding as The Score. They're spending a lot of money on this product. And so the concept is that you get people in the door, the young people in the door online, and then they're more comfortable going to the regional casinos. If you have the prediction markets and they're saying, well, you don't even have to go to a physical brick and mortar location, what's the value proposition for individuals? Plus the fact that if the CFTC is regulating it, all those 18-year-olds who can't go to Vegas, they can't go to Atlantic City, they can't go online gaming or sports betting, they now can do prediction markets. They can still bet on the Super Bowl.
Wow. So, I mean, how are these bonds trading at these companies? I'm not sure I'd want to be anywhere near these things. How are they trading?
Right. So for DraftKings and FanDuel, you are seeing volatility in their bonds. Now, DraftKings has zero coupon bonds, which they're zero coupon convertibles. And so that adds a whole other wrinkle of volatility because you're dealing with zero coupons. But for DraftKings and FanDuel, I think or Flutter rather, which is the parent, I think what's so interesting is you do see a lot of the volatility as we get more regulation indication from the markets. Now, if you fall in the camp of this year's going to still be wild, wild west, and then 27, 28 is when we start getting the regulation, as Elliot Stein has talked about and Nathan Dean has talked about, then we might be in a situation where those bonds could tighten eventually. But right now, they're sort of at the risk of losing market share to these alternative platforms.
Okay, so this is a 2-year, 3-year kind of thing where you have to really look ahead as opposed to being able to trade on this at the moment.
Right.
What kind of unexpected catalysts are you looking for in the meantime?
I think anything that would come out of the, either the Trump administration, I know that they're very deep in the gaming industry. If you look at some of the names, I mean, they have a relationship with Phil Ruffin, who owns, Treasure Island and Circus in Vegas. They are very well versed, obviously. So I wouldn't be surprised if after or if and when the Iran stuff sort of clears up a little bit, they weigh in on it because obviously they have a incentive for that. But beyond that, I mean, it really is just sort of open space. We're not really sure. But I will say, Scarlet, that the 2 or 3 year time horizon isn't so unusual when you're talking bonds. It is for stocks, but not for bonds.